Hello guys, James here with Waterford Business Solutions, and as we start rolling into the end of 2021, that means we also start rolling into the tax planning season and or tax preparation season for 2021 taxes. Q3 tends to bring that around to us, and right now is leading into that. So one of the things that a lot of people don't understand and really should is how we file taxes and what we look at for filing taxes on everything. And so we're going to spend the next few weeks doing some quick little videos explaining the different types of business taxes and the different things you can take advantage there. This week we're going to start out talking about a Form 1120S. A Form 1120S is for a small business corporation. A small business corporation can really be anyone who makes that election. It could be any legal entity developed however you have incorporated as either an LLC, as a partnership, or even as a regular corporation. You can make an S-Corp election to file your taxes as an S-Corporation. Those that are as a corporation have filed as a corporation before do have a few other things they've got to look out for when making an S-Corp election, because by transferring prior income and things like that from a regular 1120 or regular corporation return to an 1120S S corporation return, that transfer will result in dividends. So that is something to always consider and definitely talk with someone about. Make sure you talk with your accountant about that and understand the implications you're going to run into there before you make that decision. However, for partnerships and LLCs that are making this election, it is a great thing to do due to some great tax benefits that you can have. Most partnerships always file like a 1065. That's a partnership return. LLCs may file a partnership return, or they may just file a self-employed return, a Schedule C, depending on how many holders there are. But one of the things to understand before making an S-Corp election is who is eligible for this. And ultimately, it's any U.S. entity that has less than 100 shareholders, and all shareholders need to be of basically American jurisdiction. We can't have foreign shareholders, generally speaking, in an S corporation. Now, that 100 shareholders, if you have generational ownership of a company, so you can technically go back 6 generations, and all 6 of those generations, so grandchildren, children, grandparents, great-grandparents, etc., all of those could be considered one shareholder. So if it's a family-run business and you might have a ton of different family members involved in this and you're over 100, you could still be eligible for an S-corporation election. So don't throw it out immediately. A lot of people like the S-corporation due to the tax benefits that you get. And the biggest tax benefit is the fact that there is no, reduced, let me say it that way, self-employment taxes, or better known as your Social Security and Medicare taxes. When you are a standard LLC or when you are a standard partnership, you are subject to the 15.3% Social Security and Medicare tax combination there. So any wages that you take, any guaranteed distributions that you take, anything like that is all subject to that 15.3%, which is in addition to your income taxes. As a sole proprietor or as a single member LLC, you can run into that same thing. Any money the business makes can result in you having basically 15.3% in addition to your regular income taxes. So a lot of people will make this S-Corp election because it removes that penalty, or rephrased correctly, tax on people who have an 1120S or an S-Corp election. Now, that is not fully removed. Please understand that. That is only removed on anything in addition to your reasonable compensation. So as an S corporation shareholder, anyone who works for the company, anyone who is actively involved in running the company, doing something for the company, anything like that, they are subject to a reasonable compensation, which is really dependent on a per basis situation. Your reasonable compensation could be $0 in very, very few, but could be $0 in select circumstances. But most of the time, we need to consider what it is that you're doing for the company, what your experience is, and what, if you didn't own this company, what would you be paid by someone else to come up with that reasonable compensation? And then you will luckily only have to take that 15.3% on that reasonable compensation. So don't forego the reasonable compensation. That is a great way to get in trouble very, very quickly. But if your reasonable compensation, and I'm going to speak from an electrician, HVAC standpoint, since that's the predominant clientele that we work with, is those construction trades. If someone in your local geography, so Georgia, South Carolina, Tennessee, Texas, California, wherever, if another electrician who is doing the exact same thing as you, has the exact same experience, would normally be paid $70,000, then you only need to take $70,000 in compensation. That's great. You can also, in addition to that, take distributions, which are not going to be subject to that 15.3%, only your regular income taxes. So it helps to reduce the amount of things going on, and that's why it is so popular for people to take this. And that's why I'm starting here, is because it's gaining popularity as we go along. Now, one thing to keep in mind, unlike partnerships, unlike LLCs, not partnerships and dependent on your LLC, but sole proprietorships and single member LLCs, S corporations do have to file their own tax return. So you do have to file a business tax return, then you file your personal tax return. Ultimately, the S corporation will file its return, and its return has to be filed by the 15th day of the third month of the tax year. Long story short, March 15th is when it has to be generally filed, unless you file for a 6-month extension. Any business return is always due 1 month prior to personal returns on April 15th. So keep that in mind at all times, is an S corporation, unless you're filing for an extension, has to be filed by March 15th. That S corporation will file its return and then pass on to all of its shareholders a K-1. A K-1 basically shows the income, the losses, where things went to the shareholders for them to claim on their personal taxes. So that is how an S corporation reports. An S corporation, just like a partnership, just like a LLC, is a pass-through entity. The corporation generally doesn't pay taxes. However, the shareholders pay the taxes. Now, one thing in addition to pay attention to here is, if you do not file extension, or if you do not file at all, you are subject to a $250 per month per shareholder fee up to 12 months. So that can get really large very quickly, which is why it's so important to file on time. Another thing to keep in mind with S corporations is health insurance. Health insurance and disability insurance, AFLAC, life insurance, things like that. An S corporation can pay that for their shareholders or for their owners, as long as it is not claimed on line 18, or basically employee benefits. Healthcare and disability insurance and life insurance, things like that, paid for an owner, is not an employee benefit for an S corporation for shareholders. Shareholders, it would be claimed as regular wages, which means when we're doing your W-2, we need to make sure that we put that into your box 1, your wages that you receive, and you will be taxed on those wages, but not box 3 and 5. So that brings a huge question of, okay, if we're going to do that, then what about the tax deduction that I normally get by having health insurance. Well, luckily that still exists by your adjusted gross income and by a few other different tax things that we can put on your 1040. But and we're not really going to get into that, just being quite honest, but when the S-Corp is filing everything, they must go ahead and file it as wages to you, not as employee benefits. So definitely keep that in mind right there, right off the bat. So that is really a quick overview of what an S-Corp is and what we would do with an 1120S. Now, obviously, any business we go through and we find any tax deductions we can. Most of them will have very similar tax deductions, just small little tweaks like we talked about today with what qualifies you for it, how you can claim different things, where things need to go. So definitely keep that in mind. As always, if you have questions or if you'd like help in filing your business returns, since that is what we specialize in, please feel free to reach out to us, call us, email us, and we'll be happy to help you out.